Firstly, just in case there's any retail people in the audience, obviously general advice only, no personal advice, as we're a financial product. Now, just as a little overview, what is DomaCom? We're a I believe the leading fractional investment platform in Australia. It's a new segment. We're the only listed company that delivers in this segment, and effectively allows people, as the name suggests, to fractionalise an asset. As the introduction said, all I've done is really taken equity concepts and applied it to other asset classes. One of the key asset classes is property. And what I mean by that is that in equities, you don't buy a whole company, you buy a bit of a company. So we've just taken those concepts and applied them to property. You'll see that there's secondary market concepts and everything else included as well. It's a simple to use, and what I'll do is, rather than describe it later on, because I find a lot of people have a different view of what I mean by fractional investing, I'll show you some of the features of it. Our main business model is intermediated, just like with Praemium. Praemium was mostly focused on financial advisors and accountants and stockbrokers. And you'll see SMSFs are a large part of our target base, in fact represent 50% of our investors. And as I said, our focus is property. And you'll see that we've had a couple of really key milestones this last year. One of the big ones is debt. And with residential property, as you probably know, not many people buy property without debt. And the reason is it's not tax efficient. And if you're targeting financial advisors, particularly in the post-FOFA world, they have a best interest test. And the best interest includes the tax impact of your advice. And the tax impact, it's not very tax effective if you make rental income from a residential property. As the previous presenter said, commercial property is basically targeting income. Residential property, you're basically targeting growth. And so you're targeting growth investors. And so what people do is put a bit of debt in a property investment to leverage the growth. And 5-10 year pre-tax compounding, keep it more than 12 months, you get the discount rule, etc. Our products are, we're a registered managed investment scheme. It's taken us, 8 years to get to this point, 7 years of regulatory hurdles and the like. And you'll see that we've got some quite unique permissions that enable our fund to work. The management team, the key ones, myself and a guy called Ross Laidlaw, I clearly created Praemium, listed in Australia. Praemium Australia, when I left, was quite profitable business. Obviously, the UK wasn't. But anyway, so basically, I have form in this market. Ross Laidlaw, on the other hand, he comes from the Scandia business. So he set up Scandia in Australia, grew to $15 billion, and he listed, he sold it to IOOF. So Ross's background is more funds management, access to financial planners. My background is more equities with financial planners. Oops. Okay. So what did we set out to do? Well, everyone uses this word, disrupt property investing. And you'll see later on also disrupt property selling as well. Historically, you can't buy a bit of a property. Well, now you can, just like with equities. And one of the marketing things we say to advisors, would you ever recommend to a client to put all their equities in BHP and leverage it 4 times? Well, that's what people are doing with residential property. And what we're trying to suggest to advisors in this best interest test world, you really need to include this asset class for your advice. And you need to do things like diversification. So it's not all or nothing anymore. You can buy a piece of a property. And one of the key reasons why we're targeting the SMSF market, and you'll see the way we've delivered our platform, is to enable choice, because 1 million Australians have told us something. They've gone in and created 500 and something thousand self-managed super funds, gone to the effort of completing a rollover form, takes 3 months, harder than changing bank accounts. If they wanted a pooled investment as their key strategy in the SMSF, they would have stayed where they were, because that's what you get in a corporate super or industry fund. So the act of creating an SMSF tells you that they want engagement, control, and choice. And as you'll see, that is one of the key drivers of our platform. And this overcomes the key issue with property investment. Generally, it's an all or nothing. It's too large of a transaction. There's a whole swathe of the community that can't invest in property. And as you'll see, that's no longer the case. And there are different clients of DomaCom creating different solutions. And that's the thing as well, is that, as I said, we're an intermediated business model. We're like the Intel inside. We create the tool set for our clients to deliver property as part of their business. Okay. Now, rather than rather than describe how it works, I'm just going to quickly show you the core aspect of syndication. That's how we normally refer to it with financial planners. Sometimes with the media, syndication or crowdfunding, they're the same thing. So, but syndication is more for the investment markets. So we've got an arrangement with Domain. You can come on to DomaCom, use our general advice license if you like, even though we don't market it. We've had a few direct investors use this product, but generally financial advisors do this. And so here you can select any property available for sale in Australia. So in this case, I'm selecting Hampton, which is where I live. Select a property, and we've got all the listing data and integrates directly into our platform. You can look about the suburb, the picture, the beds, baths, the floor plans, etc. All the stuff you'd normally be able to see in a property listing platform. The bit that's different is that button on the top right. I want to start a campaign, a syndication, to acquire this asset. The campaign name is the address of the property, and what's the target price, what's the maximum price or the stretch price that I'm willing to pay, and how much debt do I want? Up to 60%. So our fund allows up to 60% LVR, but it's got to be positively geared. So clearly for some suburbs in Melbourne and Sydney, you're talking a 50 or less LVR. Some of the outer suburbs, you can go to 60. And we've got this lender called Latrobe. This is the thing that's taken us 5 years to get. It's actually 5 years to get the approval, and then it's taken us 6 months to go through all the mechanics of legal agreements and everything else. And I'm pleased to say 2 weeks ago we settled our first loan, and now we've got a whole pipeline coming afterwards. And the power in this is that the people creating the syndicate are not borrowing. They're not subject to the loan. They're creating a leveraged investment. The borrower is the fund, and this is what we believe Australia's first and only true non-recourse loans. All the other non-recourse loans that are sold to SMSFs, you'll find the members must provide a member guarantee. That's not really non-recourse, because they're saying, oh, if something goes wrong, the member's promising to top up their super. Okay, this is an LRBA, right? If something goes wrong, not only does the member lose their super, they'll lose their house. So, it's not really a non-recourse loan. So this is the thing that's really held our business. Up until here, every other transaction we've done in DomaCom has been unlevered. As I said before, how many people buy properties without leverage? Not many. Some of our advisors do have a small subset of clients above 55 and below 65 where they don't want leverage. They want a bit of income and they want a bit of growth. So that's why some clients have bought properties, but the majority are sub 55 and they want leverage because they want growth. They don't want income. They don't want to be taxed at their top marginal rate. So this selecting of the loan value is very important because all the people who can't apply for a loan, for example, I'm a bankrupt, self-employed, I'm a foreigner, everything else, you can have a leveraged investment without applying for a loan. You're an SMSF. You don't need to create an LRBA and a bear trust, all of this. There's $5,000, $10,000 saved just there. So it's a very, very key feature in our growth coming up. So, skip through. So yeah, so basically, then you go on and complete the campaign, and you can see we're raising 300,000. That's a bit more than 50%, and the reason for that is that we obviously might need to syndicate the transaction costs, all the due diligence, and the stamp duty, etc. Now, one of the things you'll notice, DomaCom does not select the properties, and that's the key thing. I don't claim that we know where all the best properties in Australia. Everyone else has their own view, and that thing's what, 80 people, 100 people in a room. There's 100 opinions, north-facing, south-facing, east, west, Melbourne, Sydney. And in fact, you should have a bit of everything. But, they're all right if you buy them at the right price and the right condition. So what DomaCom does is overlay a due diligence layer. So we can't buy any property at any price in any condition. When we start, when a transaction looks like it's credible, and in our case, it's about 30%. So about $100,000 worth of pledges. And pledges must be cash. There's cash in our cash account, which is earning 0.58 above the overnight rate, so it's quite attractive as well. It's better than a 30-day term deposit, and yet it's a daily liquidity feature. So at 30%, we engage a conveyancing lawyer to check the title, contract of sale. 50%, we do building inspections, pest inspections, and valuations. If we find something wrong, we stop it. Now, most of the issues that we've stopped so far, valuation issues, and a lot of them on the Gold Coast, where people have tried to acquire properties outside the 10% tolerance around allowed for in our PDS. So, and that's usually indicative of some form of collusion, corruption, kickbacks, etc. So we've not allowed those transactions. We've had 2 building inspections, so water damage in a property in Carlton and subsidence in a property in Brisbane. So anyway, otherwise, if we let if everything's fine, we let the transaction go to completion at 100%. We lock the campaign, and all investor bids receive what's called a supplementary product disclosure statement, which is the formal offer to invest. It includes the transaction objectives, the DD outcomes, the risks generally, the risks specific to this property, and it's the formal offer to invest. And if all investors say it, we go approve it, we go purchase the property. Generally, the properties are not contested because our advisors have already negotiated the price and the sale. If it was contested, we'd engage a buyer's advocate. So then we successfully acquire it. We appoint a property manager who finds a tenant, business as usual. They collect the rent. They give us the net rent after their fees and incidentals. We pay the mortgage, take our fee, and I'll talk about our fee in a minute. And then we stream any net rent to the investors, which will be marginal if we've got debt. So great, we've now bought a property. But at this point, the concern that most advisors and investors have, and probably in your mind, is great, how do you get out? Liquidity. Liquidity is one of the big issues for investors, particularly investors into property trusts, because as you would have seen during the GFC, pretty much every property trust froze. Half of them are still frozen now, 6, 7, 8, 9 years later, which means there's a lot of wariness of advisors to invest in property trusts. So how have we resolved that? We've got several liquidity mechanisms. The 2 key ones. The first one is that when we create a sub-fund, whoever's creating it, the sponsor, usually the advisor, identifies the term, and it can be between 5 and 15 years. At the end of the term, investors vote to renew for another 5 years or another term or not, and it must be 100% to renew. In other words, it's an absolute liquidity guarantee. In 5 years' time, you will get your money. At this point, the advisor says, well, what if 9 want to renew and 1 doesn't? In fact, our first 2 sub-funds have just gone through the vote, and it's exactly what's happened. 1 person didn't want to renew. Under the terms of our PDS, the people who don't want to renew can compulsory acquire the units of the people who the people who want to renew can compulsory acquire the units of the people who don't, using our second liquidity mechanism. As part of our financial services license, we've got market maker permissions. We can make a market in our instrument. We're a fund manager, and we've got an AFSL, and this has been modified to give us market maker authorization. Now, you'll be familiar with this screen. It's a market depth screen. Bids on the left, offers on the right, bid and offer price match, the transaction executes and settles immediately. What happens is that we buy off the vendor, sell to the purchaser, and we charge each side a little fee. We've just done a deal with our new cornerstone shareholder, Halo. They're going to take over the liquidity, and so they're going to market their secondary market transactions through one of their online trading platforms. So it's basically, and the reason why I show this specific transaction or this sub-fund, you may remember the Kidman crowdfunding campaign a few years ago. That was us. We had 5,500 people pledge 80 million towards the transaction. It wasn't enough to buy it. It was enough to muddy the transaction, and in fact, we got I think $20 million better price for the Kidman family. But out of those 5,500 investors, 94 got together and syndicated and bought this farm in the Western District of Victoria. And it's the best performing fund in Australia, in our fund the last 12, 18 months because of the capital growth. Now, because there's so many retail people in this one, and this is not advisor-based, they just did it themselves, they seem to be buying and selling a lot. They've done about 40, 50 transactions between themselves over the last couple of years. So it works. Now, generally with property, though, we don't market it as a trading investment because it's not. It's a trust structure with the underlying asset. It doesn't go up and down every minute. However, liquidity is needed because life events happen. Divorce, that's been one of them. Loss of job has been another, and illness. And the advisor manages liquidity. People say, well, how deep's your market? Well, it's going to be a lot deeper now with Halo, but it doesn't matter because for the advisor ones, they manage the liquidity themselves because they've got their 10 clients into this property, 1 needs liquidity. Well, they'll use our secondary market to transact that client out using another client's funds. So we're the intel inside. People say, oh, we don't see you market to the public. Well, that's not our business model. We market to financial advisors. We've got 44 dealer groups that put us on their approved product list. Now, some of you are fund managers. That's pretty impressive for a company with no performance history. So 44 times someone has added us, someone has liked us enough to agitate to get us in the investment committee agenda, and then written a paper, presented. The investment committees met, considered us, and added us. They wouldn't do it because they felt like it and it was a bit of fun. They liked the model. And in a FOFA world, how are you going to increase your fees? One way is add another asset class, okay? And that's the carrot. The stick is, if you're providing a service contract that says, I'm going to look after your retirement future, why are you excluding a whole asset class? Is that a risk going to your firm later on? Because if you're not providing a property solution to your clients, someone else is. And it'll be a property spook who invites them to the Pullman on a Thursday night, plies them with a lot of alcohol and sales pitches. Next you know, your client's a proud owner of an apartment in Yeppoon, right? Now that's impacted the risk for the client, but also your funds under management Monday are 300 grand less because that purchase needed to be funded by something, and usually it's the investment portfolio. And I can tell you, every advisor we speak to, financial planner, has had this happen to them. So basically we have a lot of advisors. It's about 5% of the market, which is not bad. Now, not many of those are using us yet and you'll see why. Affinity groups, we're really lucky because 2 years ago, no developer would speak to us because they didn't need to. They could sell anything before it was built. That's no longer the case. All of a sudden, we're getting phone calls, we're their best mate because there is, 100 or something thousand properties overhanging the market. It's apparently greater than what's reported. So these developers need a solution. Now, and there's a lot of people, interest rates are low, great. You should be able to buy a house. Getting a loan's harder, okay? Have you used Afterpay? Have you taken money out of an ATM near the Crown? All these things, it's much harder, the serviceability checks and everything else. So whilst the price is lower, interest rates are lower, they still can't borrow. So now these distribution arms of these developers, they've got one I heard the other day, for every 10 people they pitch to, only one can borrow. They can now sell to the other 9. Because if it's for investment purposes, you don't need to buy the whole thing anyway. And not just you don't need to, you probably shouldn't. You probably should spread across. So they can sell more houses by selling bits of a house to other people. So we've got quite a few discussions going on. Fingers crossed over the next month or two that some of these will come to fruition. Excuse me. The B2C play, as I said, we're not a marketer. That's not our thing. My whole business background has been marketing to financial planners and deal with Praemium. We got to 500 firms. So it's 200 financial planning firms, 200 accounting firms. The other 100 are stockbrokers, wealth managers, and everything else. I learnt the power of leverage there. And whilst Praemium all up, everyone's saying, "Oh, disaster." It's not. Praemium Australia is very good, very profitable. It was the UK that was the difficulty. But anyway, things happen at the time. So we've got the first, which is Halo. We will get others. And the thing, if we try to be the B2C play, it's only one brand and one marketing budget. Whereas if I become the engine under a lot of other people who already got very big B2C distribution businesses and everything else, I'm leveraging off their brands. And a lot of them need another asset class. So products, we're not just fractional property. We're equity release, which I'll talk about in a sec, and we're lending. So the fractional property, half of our investors are SMSFs, which makes sense because self-managed super funds like property. And in fact, I think it'll grow when you see what we've done with the ATO and sole purpose test and things like that. It's a big market, $700 billion SMSF market. Well, have we got form in this? Yeah, well, with Praemium, we got 4% of the market. So, we still have all those relationships. How do you think we got 44 dealer groups through it? We know that they like technical products. This is a technically deep product. And the accountants are detailed people. And so, that's our core market. Equity release, we've been working on this for 7 years. 7 years to create a globally unique product. So, people say, oh, you can't sell the back room or your bathroom or whatever. You can, not physically. You can sell a fraction of your house, and you'll see it's got a very, very core market that we don't have many competitors. It's a very attractive, simple product. I've been presenting the last 2 days at the Beyond Retirement Summit conference, both here in Melbourne and Sydney. It's a standout product. It's just taken forever to build, as you'll see. And then lending, because up until a few months ago, we couldn't borrow from anyone. So we modified our platform so people can syndicate their own loans. Only internally, we don't lend external to the platform. And a few of our advisors have started doing that. They've had clients who want growth, so they syndicate the equities. Client who want income, they syndicated the debt. And then that debt fund will lend the money to that property fund. Okay, and the advisor does it all in-house. Why would they do that? Because they have clients who've retired. These clients who've retired can't take capital risk. Okay, but when they did their retirement plans using Xplan, the modelling of software models their future income based on 5%. Who's getting 5% on a term deposit, low capital risk product at the moment? No one. And so they're getting 2.5, 3. They're really lucky. They can't live on that. They're eating capital. So there is a hunt for yield, and they're taking a whole lot of risk to get it. Okay. Well, here's a way they can get 4.5 for standard resi and about 7, 8.5 for funding developments with an LVR of less than 60%. Okay, where's the capital risk in there? So in most Melbourne and Sydney res, you're talking 50% LVR. It's as close to risk-free as you're going to get, And so the advisors have retirees who need income, and they have 45-year-olds who need growth, who want, their super to grow quickly. So you have leveraged resi for them, for the equity, and then you've got the 75-year-old who needs 5% or 4%, and you fund the debt. So they do both sides. So that's powerful. We're finally growing. It's taken us a while. It takes 5 years to get to 40 million, and then it's taking us 8-9 months to grow to 60 and a bit. I was hoping it's going to be about 70, 80 by now, but thing with property is we're finding it's very lumpy. And also, it's not linear. Equities, you do this happens, 3 days later, settle. Property is just, the valuer, doesn't turn up. Then you need another valuer, and then, you lose 3 weeks and so on. So, but it's lumpy, but you're going to see now, it's taken us 3-4 months to get the legal docs amended from La Trobe to fit with us, the true non-recourse loan. So, and now we have it and we've done it. And now it's cookie cutter. So we can do the next loans, and we've got one of the dealer group who did the first loan was a commercial property as well. So they bought a commercial property in Bundall in Southport, the Gold Coast. So they're now going to buy another 3 or 4 around the country and lease it themselves. All right, but they also now want to use this facility across all their clients, all their resi, and stop using LRBAs. Because why would you? Why would you pay X thousand bucks to get a bear trust created when? Firstly, I don't know whether you've seen the ATO's warning shot. Concentration risk. The ATO is coming in. The advisor's got to be really, really good to explain best interest test to put this client into one property, and it makes 80-90% of that property, that sub-fund's asset class, asset exposure. I think it'd be challenging to explain best interest there. So milestones. I'm going to talk about this in a sec. We're a fairly high conviction company. In fact, not fairly, very. So we've, constructed a legal structure and a technology platform that has very good checks, balances, arm length process and everything else. And we've been dealing with the ATO for many years to basically confirm that it's not a breach of sole purpose if a super fund invests in one of our property sub-funds and a related party lives there. We nearly got there a few years ago, then we didn't. So we went to federal court. We lost the first hearing about nearly 2 years ago. Then a year and a bit ago, we appealed to the full court. And then this time last year, or just over this time last year, we had the federal court rule in our favour. So I'll talk about that in a sec. So it is not a breach of sole purpose now for an SMSF to invest in a DomaCom sub-fund and have a related party. That's going to be a game changer for Australia. Our equity release product, 7 years with ASIC. For the first time anywhere in Australia, definitely, but I'm not aware of any product like this in the world. You can have an equity release product as a financial product. That is very important, because unless it's a financial product, financial advisors can't use it. And we've got, over the next 5 to 10 to 15 years, a very large intergenerational wealth transfer about to happen. They can start doing now using the property. And property is the core asset class of all these, either the ones who have it or the ones who want it. So, it's a very large part. And I've now got a debt facility, initial 50 million, but now I've got the initial 50 million, all of a sudden everyone else wants you. It's like, until you have a girlfriend and no one else wants you, and then once you do, you're popular, so anyway, that's my memories when I was a teenager. Capital position, look, as a startup, it's as a listed company, there's pros and cons. The pro is I'm in an environment where we can raise money, but everything's visible. Okay, our competitors are unlisted. You have no idea their balance sheets. You have no idea. You have everything else. And so, it's taking us years. It's taken us nearly $40 million to get to here. Sounds a lot of money. Compare that with BT Panorama of $600 million. I wonder how much net wealth cost. This is a platform, with a trading platform, with a registry. There's no registry that does intraday trading. Ours does. You can't buy it. We had to build it. So you'll see our capital position is one of the key hurdles for us. And look, we're growing. The market doesn't like a flat line. For the previous 4 or 5 years, it was a flat line. And now it's not like this yet, but it's not a flat line anymore. So, sole purpose test. 3 judges overruled the trial judge and ruled that it was not a breach of sole purpose for a related party. In this case, it was the daughter of the SMSF to rent a student accommodation owned 100% by the SMSF and its Part 8 associates. So this is very important. And if you know your trust lawyers, get them to ask about the Aussie golfer case. It's probably the biggest trust law case in 30 years. They're talking about it at universities now. Now, no one knows it's DomaCom because you have to use the trustee, the name of the trustee, which is Aussie golfer. So it's a great name. So it's a game changer, because what you're going to see coming, and people say, oh, you won this last year. How come you haven't been marketing it? That's because it's an 81-page document. There's a little bit of grey. So I've been working with the ATO to come up with words that they're happy with, what's called a declaration. And we're any day, could be today, could be next week. We're very, very close to getting it. And once we get it, then you'll see that this will be a tool that people can use to co-invest using their super with their children and have their children live in the place. Okay? Keep it in the family. Use your own resources. And as the judges said, the nature of, everyone says sole purpose. Oh, it's a breach of SIS Act. People are confusing purpose and motive. Purpose is financial, and a financial purpose is achieved. The motive is irrelevant if it doesn't. And it's not me saying it. That's a trial judge, the appeal judges. So we didn't want to start marketing this feature and then have a public Barney with the ATO and in the media. So very, very soon we'll have this sorted. And so it's a very large case. So at the moment it's up to 50%. But that's okay, because you probably shouldn't have everything tied up in one property anyway, as per the ATO's current notices to all the SMSFs who do own a large part of their SMSF into a property. Latrobe, as I said, without debt, no one could use us. And so, 44 dealer groups, but without debt, it wasn't tax effective. Therefore, best interest test. Debt also has the other thing, is that instead of having to raise $1 million, I only have to raise $500,000. So it's a lot easier. So it's a real key problem, both on the tax efficiency and also making the transaction easier to complete. So that's a big problem solved for us. This senior equity release, this required quite a lot of work with ASIC. All these new product intervention powers, well, they've done them on us. They've made us do consumer surveys. 1,000 vendors, retirees, looked at our disclosure documents, got questioned about them. About 10 or 15 got inside and we got video interviews of them. X $100,000 later. The product is solid. None of their competitors, like competing solutions or reverse mortgages or the home reversion scheme or whatever, have had to undergo this level of testing. And the reason for this is that this is now a financial product. We've got what's called a ASIC relief instrument. This instrument effectively is ASIC saying this is a financial product, and its class as a financial derivative product. And the relief that we have is the first of its kind. ASIC have given advisors relief from having derivative authorizations. They just need RG146. So for the first time, advisors can now do intergenerational financial planning. So it's a great business development opportunity. Most retirees in Australia can't access a reverse mortgage. 2 reasons. One is not many of them are around. Every major bank is pulled out right when all the baby boomers are running out of cash. Millions of them got the big house. Most of them want to retire in situ, but they need additional cash resources. So it's a very big market, and all the banks are pulled out. But also the ones that have remained. You probably remember 2008, there were ads everywhere for reverse mortgages. There were 21 schemes. All these happy couples going off to the, retirement, Golden Acres retirement village or whatever. The issue for them, as I found looking into reverse mortgages, is their funding source. The first day of the GFC, 17 of those 21 shut. Why? Because they borrowed 2, 3, 5-year money from the wholesale money markets and lend 15-year money. Okay? And for 15 years, you get no cash flow. So what happened on day 1 of the GFC? Securitization markets froze. And they all died. They haven't solved this funding problem, except there's the household capital. They're getting their money from industry funds, so they're going to be a long-term player. But everyone else, there's no banking solution or anything else for this. Whereas, what have we done? What asset class has an investment horizon of 15 years and also an investment appetite? The SMSFs. A 40-year-old with an SMSF can't touch their money for 27 years. So there you go. You've got a market that's $700 billion. Some of the forecasts that I've seen for equity release needs is that for the next, I think at the moment it's $3.5 billion. If it was funded, it would be about $8 billion. It's going to grow to $30 billion by 2025. $30 billion sounds a big number. As a percentage of a $1 trillion SMSF market, it's not. And the way we structured the product is that investors receive 3% cash yield plus the capital growth. So what we do is we buy a bit of the Aunt Marge's house using investors, and we buy, and some of that most of it we'll give her in cash. The other bit we'll leave in a account within DomaCom, which is her money, and it pays the rent for 5 years, which is 4.4%, of which 3% goes to investors. And every 5 years, our investors buy another 5 years worth of rent. That's how our product works. Very simple. There's a lot of detail in it, but it's a very big opportunity. There's something like $500 billion in cash in over 65s now, according to Deloitte. So, hence why we've invested years and millions of dollars in it. We are now the only financial product. Now, to advisors, we say, hey, it's a great business development opportunity. There's millions of people that need it and they can't get it from any other source. And a lot of them are your own clients. Okay? But also, how could you serve a client all their investment life until they're 70 and then say, oh, no, can't do anything for you? So anyway, so that's that product. B2C strategy, I said, we're constantly seeking B2C partners. We've got the first one, which is Halo, and I think we'll see more coming forward. SMSFs, as I said, SMSFs basically don't need to create an LRBA. They just click a button. The lender doesn't like this. It's no doc lending because the investors aren't borrowing. It's very easy. We're in an environment where everything's hit us at the right time. The property, people say, a few months ago it was, poor boys, you're in a downturn. Well, it's actually much better to be 18 months into a downturn than right at the top. Okay, so it's a much easier sell. We use equity concepts like dollar cost averaging, because guess what? You can do that now. An advisor will syndicate, clients into a property this quarter, next quarter, quarter after. They'll end up a bit of 4 quarters. Now, some of them are going to be high, low, at the bottom, whatever. So you can use all those techniques. So the property sentiment has improved, aging population with the product. We're the only product that advisors can use. Obviously, we're growing as well. That's a great driver for property. Every bank has withdrawn from SMSF lending. So SMSFs don't like property less than they did 2 years ago, but every bank has pulled out. And so lending environment is difficult, and housing affordability, whilst superficially it looks great, it's still hard because you can't borrow. Financial planners are our core market. We've also targeting institutions, developers, affinity groups who have a large distribution channel themselves. Cash poor retirees, you don't have to speak to a lot of your own contacts. There's lots of them and it's growing. And SMSF, that's a market we've come from and connected to. Our fees, we're a fund manager. For the property assets, we charge 88 bips, including GST. Mortgage assets, 44 bips, and cash, 22. So it'll be very easy to see how much money we make and how we make. Just figure out what percentage of these 700 billion we're going to get in DomaCom and multiply that by 88 bips. That's our revenue. We're a leverage structure, so once we cover our costs, it'll just grow. Recapitalisation, we've raised nearly 9 million since last year. There's a rights issue currently being structured, currently been underwritten, sub-underwritten as well by Ascot Securities. This will address the final hurdle for DomaCom, which is our balance sheet. This will fund us till at least the end of next year, and then the transactions will grow after that. Volatile, we're closer to the bottom than the top. So, and this is a high conviction business. But you're coming in at a much lower price than a lot of other investors. So I said, nearly 40 million to date. Key takeaways, funded for growth, big addressable market. We're not a niche play. If we succeed, we'll be a mainstream player in the market, bigger than a lot of other listed companies right now. Experienced management team, we've done this before. We're regulated, obviously ASIC and ASX, and that's one of the advantages here. So we can win clients because we're ASX listed. Here's the disclaimer. I'm sort of available for some questions.
We've just got a few minutes before we break for the morning tea. Just want to... Yeah.
Hello, I would like to know if your property that products is available for the overseas purchases.
Yeah, we've already got some land banking that's been done, and so Chinese direct investors have logged on. That client has a Chinese language version of our application form. So at the moment, we have to switch on the countries. The countries that are switched on are China, obviously, and New Zealand. Yeah, that's the only one. But we can switch on others. There's some countries, obviously, we can't ever deal with, like Nigeria and a few of the others. But yeah.
Thank you.
Any other questions?
There's one more there.
Hi, could you reiterate the liquidity part? If I'm an investor that I invest in a purchase a share and I want out in the future, how do I get out? You mentioned that other investors can buy off me, but what if other investors don't want to buy that? Where is the money going to come from?
Well, it's a market. You keep dropping the price and you'll get a buyer, okay, because it's a real asset, it's streaming real returns, or you wait till the end of the 5-year term, in which case you'll get your share of the value of the property as it is then.
Where is the money going to come from at the end of 5 years?
Oh, we sell the house.
Okay.
Yeah, we just sell the house, wind up the sub fund, you get your share.
If the vendor does not want to sell, is it
No. The vendor is in terms of the house, the DomaCom fund or the trustee owns the property, and under the rules of the fund is that if we don't get authority to renew the property, it's a wind-up event. So we'll wind up the sub-fund, sell the house, redeem everyone's units, and you'll get your share. If you own 10% of the units, you'll get 10% of the proceeds.
From your information, I thought you were purchasing a portion. So you're purchasing the whole property?
No, DomaCom is purchasing the whole property for the normal residential investment, but you as the investor can only purchase 5% of that, okay? But the fund itself owns 100% of the property.
Sorry to keep your time. In your senior,
that's a senior equity release. That's a different. That's where we own a bit of the house. But yeah, and in that case, there is that we can't ever sell the house. So what we can do is sell the contract. So if the investors decide not to fund the renewal, it's a wind-up event for the sub-fund. But the asset of the sub-fund in a senior equity release is a contract. So we will sell the contract to someone else, just like mortgage funds sell mortgages between funds. It's an asset. At a price, we'll sell it.